2 days ago, I bought Amdocs stock, ticker symbol DOX, and in this video I want to share with you why. And if you're new to this channel, this is my current strategy with dividend stocks. I employed with half of my portfolio, 50% of my portfolio is dedicated to this strategy, where I buy dividend stocks which yield around 3 to 6% when they have an upside, like they're a bit of undervalued or trading below their historic valuations, and I wait for them to get to their historic valuation to see when it seems they have no upside left. That's the point where I sell and I collect the dividend in the meanwhile. I also sell put options when they are in the lower range of their valuation. So Amdocs stock is yielding below 3%. It's currently yielding 2.2%. And I'm already thinking that maybe I will officially extend this clause of my strategy to include 2 to 3% yielding stocks also, because I have a few already and I pretty much love them. Usually they lower the yield, the more kind of quality we will get. Not always, but there is something to it. And I've found already a few opportunities that I like in terms of the safety and the upside in the 2 to 3% range. So maybe right now I'm just adding Amdocs, but maybe I will officially start to screen for those also. So yeah, but today we'll talk about Amdocs. It's gonna be pretty brief. There's not much to say. We're just doing an overview of the financials and the current state and the historic growth, the forecasted projected future growth, and see where my price target is. And that's good. I think it's good. We like companies when there is not much to say. It's really uncomplicated and pretty simple and easy. I hope I will not be disappointed in this in the future. But yeah, so let's begin. So Amdocs, just to give a brief overview of the business, no presentation today, is a company that does IT services, mostly for telecommunication mobile network companies. Their biggest customer is AT&T, which comprises around quarter of their revenues, but the other customers are also mobile services, most of them in the United States, in Europe, and in Asia also. The kind of services they provide is extensive, where they develop systems that help the telecommunication companies to manage their processes, their billing, their inventories, their activation processes, all of that. They've been in business for many years now. They've been working with those customers for many years now also, especially with AT&T. They have a really strong relationship with. And we can see here already that the company has been growing really, really nicely for many, many years. And their growth stems today more from the expansion within those customers. They're also gaining new customers, and they have new products and new offerings, mostly to the same customers. But their expansion within the same customers, when they're able to provide more services, more solutions, and capitalize on changes, on developments and new technologies that are available. So currently they are trying to capitalize more on the 5G adaptation that the cellular networks are doing, and they're offering more solutions and more systems and more IT software and help with the adaptation of 5G. They also offer a lot of help with moving to the cloud, with transitioning to the cloud. So that's a big business for them, which is also has nice growth, which is the bigger growth within the business. So that's overall about Amdocs. Again, very dependent on the mobile network companies and this sector. But I think it's also a good example of selling picks and shovels, where AT&T and Verizon, for all those companies are super capital intensive, and they're struggling to always extend their networks and build the next generation. And then they need to think about how to profit from it with the high debt burdens they carry when they need to raise all that infrastructure, while Amdocs is just selling software. It's capital light to those businesses, and it manages to extend its offering and extend its business in this field on top of those companies. And we see this really more reliable, more quality track record of growth and of earnings. So let's look a little bit at the historical growth. We see here the historical growth of the earnings, but it's not the full story because the company is buying back shares aggressively for many years now. So looking a little bit at the growth track record of the company with different metrics, we can see it has been growing all of its metrics really nicely for many years now. This is the revenue for 30 years now, which we see has been growing. We see this little bump in the financial recession, and we'll talk later about the recession sensitivity of the stock, where it is a little bit sensitive. It will be hurting in a recession, but not super cyclical, just a little bit. We'll talk about it. This is the EPS, which also has been growing, the EBIT, the EBITDA, which we also see the growth, the free cash flow, the operating free cash flow. So really a nice track record of growth. We see that the growth of the revenue for the past 10 years has been around 6 to 7%. The growth of the EPS has been a little bit higher because of the share buybacks. So in terms of growth, really a nice track record. We see that the company has been managing to expand its revenues from its existing customers. They're also winning new customers, but most of their growth is coming from those existing customers when they manage to offer more and more solutions, and they probably raise prices also and increase the value of their customers. Just to look a little bit at the cash and debt situation, again, we see the nice track record of the revenue growth. If we take out the revenue, we see that the EBITDA and net income have been growing nicely until 2021, and since then we see a slowdown, like there is a slowdown in the economy. Everybody's feeling it, and Amdocs is feeling it too. Their customers are a little bit tightening their budgets. It's not the worst. We see that the company has a really, really low debt. It has only 800 million in debt, and it has as much in cash also constantly, not just now. Really almost no debt. If to compare it to free cash flow of 700 million, or even the year before that of 500 million, 550, it's really low debt, really, really impressive. A little bit high stock-based compensation, but like all software companies nowadays, not the worst. We see the return on invested capital is constantly around 10%, very stable, very predictable. 10% is nice. It is supposed to be a capital light business, so at 10%, it's okay, it's fine for a software company again, but it is very profitable, definitely, no doubt about that. And the shares outstanding, which have been constantly going down in the number, they have been buying shares every single year. So really, I like everything that I see. It looks really good, very sustainable, predictable. They're, I think, around 70%, maybe 75% of the revenue is recurring revenue. They have long-term contracts with their customers, with AT&T and the other mobile service networks, where they have a multi-year contracts. So even when those companies are experiencing a kind of tough times, they're not really so quickly able to get to reduce their expenditure on Amdocs. And it is predictable for years ahead. So really predictable and consistent earnings and growth. So looking a little bit about on the capital allocation and expenditure of their cash flow, let's look at the cash flow statement a little bit. We see the net income is around $500 million for the past few years. Around it's been a little up, a little down, and the cash from operations is around $700-800 million. Their capex is around between 100 and 200 million, and the company have been spending around $500 million each year for the past few years on share buybacks, where the expenditure on the dividend is now over 200 million. So that so putting all that together, we see that the dividend has a cushion. They just need to reduce the share buyback. So the return to shareholder is really the biggest portion of their cash usage, where the capital expenditure is lower. So nothing wrong here. Everything looks good. The only thing that a little bit concerning to me, but I wasn't able to get any data about it, is their accounts payables is a little bit elevated for the past 2 years. So take into consideration that they still needed to pay this cash. Here the accounts payable is suddenly pretty inflated. I'm not sure why that is. I tried to look into financial reports, but there was no note about it. It is a company that is not American, so it has a different kind of a 10K, and there was no information about why the accounts payable is a little bit elevated. So they probably will need to pay down. So that's also, I hope they just will pay down, and there's nothing even more disturbing here, but it's also kind of around pretty 100-200 million dollars that they still need to pay. So yeah, so let's look a little bit on the dividend. We see the company has been growing its dividend since it's initiated it in 2012. So not the most amazing track record, but since they did, they seem very committed to the dividend, and it seems really safe. So it's not, although it's not long, it does seem very safe to me. The growth rate of the dividend has been around 11% for dividend growth investors that look at this metric. Also, the payout ratio, as we've seen, is not high. More capital goes to the share buybacks than to the dividend. So yeah, and the current yield is, like I said at the beginning of the video, 2.2. Currently not high dividend for me, but again, I get the quality in return, which I like, and the predictability and the upside, which we'll talk about in a minute. So in terms of valuation, we see that Amdocs have been trading in the last decade around a PE of 15.5, around something like that, where before that it had a long period when it traded lower. But it's not only Amdocs. I'm looking at a lot of companies, and there are many companies that following the recession, it took some time until interest rates were lowered, and until confidence was back, and until the economy was doing good again, and a lot of stocks have been trading at lower multiples. But it just goes to show that it can happen again. That's what I'm saying. I'm not saying that's different now. It can happen any day, but as long as there's not such a hard, difficult economy, we see that it has been trading around a PE of 15. Before that, it was trading even higher, but it still had a higher growth then. So looking at the multiple of the last decade of 15.5 PE, we see that now Amdocs is trading at a 13.5 PE. So on this graph, it does seem like it has an undervaluation. I do believe it does have it. And looking forward, if we look at the estimates for the next few years, because of the tougher macroeconomic conditions where Amdocs's customers are tightening their budgets, the revenue growth is really slowed to around 2-3%, and this is what is estimated for this year. And as long as we don't know any better, it's what estimated for years after that. Probably in normal conditions, the company could have grown around 4-5-6%, not more than that. But with the aggressive share buybacks, the EPS growth is much higher, around 9%. So that's why we see here the 9% growth in the EPS, the non-GAAP EPS. But I think it's fine because the company is not only buying shares this year, it's buying it every year, and we can count on it to continue in some sort of way, as long as it's not some kind of a black swan event. So this projection of growth of 9% in EPS, that's as long as business continues as it is right now, which is not stellar, but also not a recession, obviously. If we look at the recession sensitivity of Amdocs, we see that it was pretty much flat during the recession in terms of earnings, and this is really impressive. I mean, on one hand, its customers are going to tighten their budgets in tough economic times on where they hit rough waters, and Amdocs is going to feel that. On the other hand, those are very, very essential and non-discretionary services that Amdocs provides to those customers. I mean, they could, AT&T could maybe forgo their, I don't know, analytics and AI projects, but it could not forgo its billing projects and its 5G projects. So those are really the core of those businesses. Plus, they have those long-term contracts that even if AT&T now feels tougher economic times, it cannot really easily reduce its expenditure on Amdocs. So its recession sensitivity, I would say, is low to medium even, but even medium is still, for me, is fine. So yeah, so from the current price, I mean, it was trading a lot lower already, and I missed this opportunity. I bought it 2 days ago around this price that this is today. It hasn't moved a lot. So from this current price, my price target is around somewhere around $105, $108. So it has an upside of around 25%, excluding the dividend, and that's what I'm after. So yeah, so that's about my price target. That's what I will sell. Let's look a little bit at cash flow. We see that with the cash flow, it's more trading around its normal multiple for the cash flow, but also because of the growth and expected growth of the company, we can see also around $100, but it can also get above this blue line because it's tracking it pretty nicely, but not as nicely as the earnings. So yeah, somewhere around $100. Let's look at basic earnings just to see there's not anything fishy here. Also a similar story. So yeah, so not much to say here. Looks really good. Growth is good. Dividend is good. It has a little bit of upside, not like 50% upside, 20%. I feel that like now that's exactly what I should aim for, because when companies have a lot of undervaluation, when their stock prices fall and they have a lot of an upside also, they usually a good reason for it, and it represents some high risks also. I have a few of those, like UGI, for example, but this kind of a profile when it's just a little bit undervalued, not without any reason. It is undervalued because the growth is slowing this year, and we don't know for how long of the revenue. And it's something. It's important. I mean, if the company hits even harder times, it might need to stop the share buybacks, and then the growth in DPS will also slow. So there is kind of this risk, but I think long term, there's nothing alarming about the business long term. Again, the debt is really low, so so I think it balances my portfolio really well. And it's in addition, I put like a medium plus position in it on the larger side. I like it. Yeah, so I hope we'll see. I will let you know when, where and when it will get in the future with my position. So yeah, so that's it for today. I'm nearing the point where I deployed all the cash I wanted. I still aim to sit on around 18% cash, because I do have the collateral for the put options I'm selling. And I kind of, I don't know, like I feel I should sit on a little bit more cash maybe than in other times in the market. But I'm already almost there. and then I will begin to rotate my less favorite positions to new opportunities I find. Those are probably going to be at first the non-dividend stocks, which I have a few that I will kind of already want to sell. I will share that also here, and that will increase my dividend portfolio above 50%, and I'm totally okay with it. I'll admit I haven't tested this strategy for enough time, but I feel good with it. I already feel like it's working the way I wanted it to. Of course, with the understanding and the knowledge that there will be different times in the market and it will work differently, but I also like this strategy, I think, in the case of a recession, and that's why I'm doing it, and that's why I'm not exactly rushing to compare my performance also to the S&P 500. Maybe I will benchmark it eventually against the SHED ETF. I'm not sure yet. I will begin to track it more in the upcoming weeks, and I will be able to benchmark it. But again, I'm aiming for it to be kind of an all-weather strategy for me when I generate income for my family and all weather conditions in the market. I hope that will work out. So yeah, so that's it for today, and then see you on the next one. Bye bye.